Good morning, students. In this session, I will discuss the tax implications when an individual contributes property to a corporation. So you contribute a property to a corporation, and what are the tax implications? Let's discuss that. So you contribute property to a corporation, and what you are getting in return? You're getting corporation stock. You're getting shares of the corporation. Now, what are the tax implications? What are the tax implications to you? What are the tax implications for the corporation? You can buy shares of that corporation, but you can also contribute non-cash property and get shares of the corporation. How you deal with that? What are the tax implications? Let's discuss those. All right, let's read. A contribution of property to the corporation. So you're contributing a property to a corporation, and this property we are talking about is non-cash property. So you contribute a property to the corporation in exchange for that corporation stock. And this is considered a sale of property. So you contribute a property to the corporation and you're getting corporation stock in return. And this is considered a sale of property by you to the corporation. It is considered as if you're selling the property to the corporation and you recognize gain or loss. All right. So you contribute a property to a corporation. And what type of corporation we are talking about? As I discussed in earlier session, that a corporation may be a C corporation or S corporation. And you know how they're different. S corporation is a pass-through entity. You also call that flow-through entity. S corporation does not pay taxes on its income, but tax on S corporation's income is paid by shareholders of S corporation. I'm talking about S corporation. We had discussed this in earlier sessions, that S corporation is a pass-through entity. S corporation does not pay taxes on its income. Then who pays taxes on S corporation's income? Shareholders of S corporation. Now, what about C corporation? C corporation is not a flow-through entity. It is not a pass-through entity. It pays taxes on its income. C corporation pays taxes on its income, and after paying taxes, whatever distribution it makes to its shareholders, shareholders also pay tax on those distributions. There are rules regarding taxability of those distributions. We will discuss those rules in another session. But yes, in case of C corporation, there is double taxation. C corporation pays tax on its income. Shareholders of C corporation also pay tax on the distributions received from C corporation. But in case of S corporation, there is no double taxation. So you contribute a property to a corporation, and that corporation may be a C corporation or S corporation. And what you're getting in return, you're getting that corporation's stock, shares in that corporation. So this transfer of property from you to corporation is considered a sale of property, and you recognize gain or loss. So what is the amount of gain or loss in this case? How you calculate gain or loss? So fair market value of the stock received is reduced by the basis of the property transferred, and you have gain or loss. But when you transfer a property to a corporation, you also have to consider Section 351. So under Section 351, any gain you realize on transfer of property to corporation in exchange for corporation stock is not included in your income. You do not recognize that gain. You do not recognize that loss. Why? Because of Section 351. Let's see. When one or more shareholders transfer property to a corporation, one or more shareholders. So here we are talking about a group of shareholders. It may be one shareholder, it may be a group of shareholders. We also call this a control club. Why we call it a control club, we will see. So when one or more shareholders transfer property to a corporation, only in exchange for stock. So you transfer property to a corporation, and what you are getting in return? Corporation's shares. So these are corporation's shares. And this may be common stock or preferred stock. But it does not include stock warrants, rights, and options. So when one or more shareholders transfer property to a corporation, only in exchange for corporation's shares, and the shareholders are in control of the corporation immediately after the exchange, then the shareholders do not recognize any loss on transfer, do not recognize any loss, and recognize gain on transfer only up to the amount of boot received. If you are in control of the corporation immediately after the exchange, then you do not recognize any loss on transfer and recognize gain on transfer only up to the amount of boot received. But if you want to take advantage of section 351, where you recognize gain only up to the amount of boot received and you do not recognize any loss, then certain condition must be met. First is that you are transferring a property. What you're getting C corporation stock. Also, you are in control of the corporation. What control means, we will see that in a moment. And here, shareholders, this is again control club. Now, when you are considered to be in control, let's read. The transferring shareholder as a group are considered in control. So you are considered to be in control of the corporation when immediately after the exchange, those shareholders, that is you along with other shareholders who transferred property, when immediately after the exchange, those shareholders own at least 80% of the total combined voting power of all classes of stock entitled to vote, and at least 80% of the total number of shares of all other classes of stock of the corporation. So if you own 80% of voting power and also own 80% of number of shares of other classes of stock, then we say that you are in control of the corporation. So here we are actually classifying the stock into two categories: stock with voting power and stock without voting power. You are in control of corporation immediately after the exchange. And how you say that you are in control of the corporation? If you have 80% of the voting power. This is with respect to stock that is with voting power, that has voting power. So you own 80% of voting power. You also own 80% of number of shares of that class of stock that is without voting power. So corporation has various classes of stock. Regarding stock with voting power, you should own 80% of the voting power. Regarding stock that does not have the voting power, you should own 80% of number of shares. When I say that I control that corporation immediately after the exchange, I own 80% of voting power of that class of stock that gives me the right to vote. I have 80% voting power. Now, what about that class of stock that does not give you any voting power? I own 80% of total number of shares of that class of stock. All right, any questions? All right. So to be in control of any corporation, you should have 80% of the voting power, plus you should have 80% of number of shares of other classes of stock, that class of stock that does not have voting power. All right. So under section 351, if you transfer property to a corporation and you're getting only stock in exchange, and you are in control of the corporation immediately after the exchange, then you do not recognize any loss on transfer. Also, you do not recognize any gain. But if you receive boot, then you may have to recognize some amount of gain or maybe the entire gain, depending upon the amount of boot received. First thing is that what actually is boot? So what is boot? Boot is any property that you receive other than stock. So you transfer property and get stock. Along with stock, you are getting cash. For example, cash received is boot received. You receive building from corporation. That is boot. You receive shares of any other corporation. That is boot. In case you receive any property from the corporation other than corporation stock, generally you receive cash along with stock. So in case you are receiving cash along with corporation stock, it is boot received. So you transfer property to C corporation. What C corporation is giving to you? Stock plus boot. Let's say, what is boot? Let's say, for example, cash. Now, in case you receive boot, then some amount of gain or the entire gain may be included in your income, and you may have to pay tax on that income. You may have to pay tax on that gain. The entire gain will not be exempt. So what amount of gain is included in your income? It is stated here. So you recognize gain on transfer up to the amount of boot received. Up to the amount of boot received. So if it is a section 351 transaction, then you recognize gain that is lower of gain realized or boot received. We will do a question on this. So if you're receiving boot, then no loss recognized, but gain is recognized only up to the amount of boot received. So you're not receiving any boot. It is a section 351 transaction. No need to recognize any loss or gain in the transaction because it is section 351 transaction, because you have not received any boot. But if you receive boot in a section 351 transaction, then you still do not recognize any loss. Do not recognize any loss. You receive boot in section 351 transaction, do not recognize any loss, but you may have to recognize some or all of the gain in a section 351 transaction because you received boot. So if you receive boot in a section 351 transaction, then you recognize gain that is lower of gain realized or boot received. So if you receive boot, no loss is recognized. So you do not have to recognize any loss in a section 351 transaction, even when you receive boot. But you may have to recognize gain if you receive boot in a section 351 transaction. Now, what about liabilities assumed by a corporation? So your liabilities are assumed by a corporation. You're transferring a property. What you're getting in return? Stock of corporation, shares of corporation. Also, corporation is assuming your liabilities. There may be a mortgage on this property that you are transferring. That mortgage is assumed by the corporation. Now, corporation will pay that loan on property. This is liabilities assumed. Your liabilities are assumed by corporation. Now, the question is that, is it boot received? Now, how you deal with liabilities assumed by the corporation, we will talk about that in another session. But the question that whether liabilities assumed are considered boot, the answer to this question is that liabilities assumed are generally not considered boot received. Generally. But in exceptional circumstances, it is considered boot. So it is considered boot only in exceptional circumstances. What are those circumstances? I will discuss those in another session. I will discuss in detail the tax implications of liabilities assumed by corporation. What are the tax implications when a corporation assumes shareholders' liabilities? I will discuss all that in detail in another session. All right. But yes, as of now, any liabilities assumed by corporation are not considered boot received, generally not considered boot received, but in exceptional circumstances, liabilities assumed may be considered boot received. All right. Okay, before we take a couple of examples on Section 351 transaction, let's discuss how basis of stock that is received by the shareholder is calculated. So the basis of stock received by the shareholder is the adjusted basis of the property transferred, modified by any gain or loss recognized on the transfer, cash or fair market value of the property received, and liabilities assumed by the corporation. So we are calculating basis of stock in the hands of shareholder. So what is the basis of stock in the hands of shareholder? What actually happened? Shareholder transferred property and got stock. This is the stock of C corporation. So shareholder transferred property and received stock. What is the basis of this stock in the hands of shareholder? So our starting point will be adjusted basis of property transferred. So we are calculating this basis of stock received, and our starting point is adjusted basis of property transferred. This is our starting point. This is increased by any gain recognized on transfer minus loss recognized on transfer. So there will be either gain or loss. Any boot received, that also reduces the basis of stock. And also shareholder liabilities assumed by the corporation. What you get? Basis of stock received by shareholder. All right. So this is how you're going to calculate the basis of stock in the hands of shareholder. How we are going to calculate that, we will take an example. Another thing that you should know is the basis of property in the hands of corporation. So corporation is receiving property from the shareholder. Shareholder is transferring property to the corporation. Now that property belongs to corporation. What is the basis of that property in the hands of corporation? All right. So what is the basis of property received by the corporation? So again, the starting point is the adjusted basis of property transferred. This is the basis to shareholder. This is the basis to shareholder. And this is increased by any gain recognized by the shareholder on transfer. And it is reduced by any loss recognized by the shareholder on the transfer. This is basis of property, the hands of corporation. All right. Any questions? Now let's take a few examples. Suppose A transfers a property and this property has an adjusted basis of $90,000 to A and has fair market value of $130,000. And A transfers this property to X company in exchange for let's say 20% stock. And this has a fair market value of $100,000. A also gets some cash. Let's say this is $30,000. What are the tax implications in the hands of A and X company? If you have to answer this, what is the first thing that you check? First thing that you check is that whether it is a Section 351 transaction or not. Now in this, A has only 20% shares of X company. So this is not a Section 351 transaction. So this is not a Section 351 transaction. Now, because this is not a Section 351 transaction, the entire amount of gain realized by A is recognized, or the entire loss incurred in the transaction is recognized. So entire gain or loss is recognized by A because Section 351 is not applicable. All right. So what is the amount of gain or loss? Total consideration received by A, fair market value of stock, and cash. So this is $130,000. From this you deduct adjusted basis of property transferred, which is $90,000. Gain recognized by A is $40,000. Any questions? What is the basis of stock to A? You will start with adjusted basis of property transferred. That is $90,000. Increased by gain recognized in the transaction, $40,000, and reduce it by any boot received. That is $30,000. So basis of stock to A is $100,000. Any questions? Now, what is basis of property to X company? You start with adjusted basis of property in the hands of shareholder. That is $90,000. And you increase this by any gain recognized by A, $130,000. This is basis of property to X company. Any questions? All right. Let's take another example that A transfers a property to X company, and this property has adjusted basis to A of $90,000. This property has a fair market value of $130,000. And what A is getting in exchange? A gets what? A gets 80% stock. Of X company. This has a fair market value of, let's say, $115,000. A also gets cash, $15,000. Now, what are the tax implications? Again, first thing that you will check is that whether this is a Section 351 transaction or not. Now, in this transaction, immediately after the transfer, A has control of the corporation. A controls the corporation because A has 80% stock of X company. Because A has 80% stock of X company, this is a Section 351 transaction. So this is a Section 351 transaction. Now, what is the amount of gain or loss recognized in a Section 351 transaction? You guys know that in a Section 351 transaction, no loss is recognized, regardless whether you are receiving boot or not. So whether A has received any boot does not matter. But if A realizes any gain, then gain is recognized only up to the amount of boot received. So let's see how much gain or loss is realized by A. First, we will see that, and then we will see how much you have to recognize. All right. So total consideration received by A is $115,000 for stock and $15,000 cash. In total, A is getting $130,000. And this is reduced by adjusted basis of Property transferred by A. Adjusted basis is $90,000. 40,000 is gain realized by A. But what is the amount of gain recognized? Will A recognize the entire $40,000 gain? The answer is no, because this is section 351 transaction. So gain recognized by A is lower of gain realized or boot received. So A will recognize a gain of $15,000. Any questions? Now, what is basis of stock to A? Again, the starting point will be adjusted basis of property transferred, which is $90,000 plus gain recognized by A, $15,000 minus boot received. $15,000. $90,000 is basis of stock to A. Any questions? Now let's calculate basis of property to X company. Starting is adjusted basis of property transferred. This is adjusted basis to A. And this is increased by gain recognized by A. This is $15,000. In total, it is $105,000. This is basis of property in the hands of X company. This is the tax basis of property to X. This is the basis for tax purposes. This is the basis of property that X will use for tax purposes. All right. Any questions? Now let's take an example when an individual transfers multiple assets, multiple properties in a section 351 transaction. And what are the tax implications? All right. So A transfers 3 properties to X company. Adjusted basis of these properties are given to you. Adjusted basis of property 1 is 70,000. Property 2, $100,000. And property 3, $70,000. Fair market value is also given to you, $60,000, $120,000, $120,000. Gain or loss realized, in this case, it is $10,000. In case of property 2, it is $20,000. And in case of property 3, it is $50,000. Total gain is $60,000. So A transfers 3 assets, asset 1, 2, 3, property, or you can say. So A transfers 3 properties, property 1, 2, 3, and receives cash. And A gets 90% shares, let's say. Fair market value of this stock is $250,000. A also gets cash. This is boot received, $50,000. Now, what are the tax implications? Now, in this case, if you look at the consolidated picture, if you look at the transaction in totality, then you see that A transferred 3 assets. Basis of those assets is $240,000, and the fair market value is $300,000. Gain realized is $60,000. Boot received is $50,000, and you know that in a Section 351 transaction, gain recognized, not realized, gain recognized is lower of gain realized or boot received. So it should be lower of $60,000 or $50,000. So if we take a consolidated view, A should recognize a gain of $50,000, but that's not correct. That's not correct. Because this is a case of multiple assets transfer. Because this is a case of multiple asset transfer, we cannot take a consolidated view. We will deal with this transaction as if there are 3 transfers. And if there are 3 transfers, what is the amount of gain or loss that should be recognized by A? So there are 3 transfers, 3 individual transfers. So we will talk about these 3 transfers. We will discuss these 3 transfers. We will see the tax implication in these 3 transfers. So A transfers asset 1, gets shares and cash. A transfers asset 2, gets shares and cash. And A transfers asset 3 and gets shares and cash. First thing that you are going to do is that allocate this boot among all the assets transferred in the ratio of their fair market value, in this ratio. What is the amount of boot received? This is the amount of boot received, $50,000. Divide this among 3 assets transferred. So allocate boot. Boot allocated in the ratio of their fair market values. That is in the ratio of 1 ratio 2 ratio 2. That is 60,000 ratio 120,000 ratio 120,000. Allocate this. This 50,000 is allocated in the ratio of 1 ratio 2 ratio 2. This comes to 10,000, 20,000, 20,000. This is boot. Now look at all the transfers independently, individually. So A transfers asset 1 and gets shares and boot $10,000. A transfers asset 2 and gets boot $20,000. A transfers asset 3, gets boot $20,000. What is the amount of gain or loss recognized? So if we look at asset 1, A incurred a loss of $10,000. And because this is a Section 351 transaction, no gain or loss is recognized by A in respect of asset 1, in respect of property 1. No gain or loss is recognized by A. In respect of property 2, A recognizes a gain that is lower of gain realized or boot received, that is lower of these two figures. Lower of these two figures is $20,000. In respect of asset 3, A recognizes a gain of lower of gain realized or boot received, that is again $20,000. Gain recognized is $40,000 and not $50,000. Any questions? Because we are not taking a consolidated view, we are taking these three transfers individually. We are also determining the amount of gain or loss that should be recognized by A individually in respect of all the three transfers. Now, what is basis of property to X company? You know how to calculate this. The starting point is adjusted basis of property transferred plus any gain recognized minus any loss recognized. There is no gain or loss. Plus 0 minus 0. That is $70,000. In respect of property 2, starting point is adjusted basis, $100,000. What is the amount of gain recognized? $20,000. Total comes to $120,000. This is the basis of property to X company. Basis of property to X company is $120,000. What is the basis of property 3? Starting point is adjusted basis plus gain recognized 90,000. Basis of property 3 to X company is $90,000. Any questions? Now, what is basis of stock 2A? Starting point is adjusted basis of property transferred. $240,000 plus gain recognized by A, $40,000 minus boot received. You get to a figure of $230,000. This is basis of stock 2A. Any questions? Now let's discuss loss duplication transaction in a section 351 transaction when you have multiple assets. How are you going to deal with that? So it is a section 351 transaction and there is multiple assets transfer. And also there is loss duplication. What actually is this loss duplication and how you're going to deal with that? Let's discuss that. So A transfers 3 assets, 1, 2, and 3 to X company. All right. So you have 3 assets and the adjusted basis is given to you. You have fair market value of these assets. So adjusted basis and fair market value of these three assets are given to you. Let's calculate gain or loss realized. What is the amount of gain or loss realized in this case? It is 40,000 loss, 70,000 gain, and 20,000 loss. All right, so this is the transaction. What A gets, let's say again 90% stock of X company, and it has a fair market value of $136,000. A also gets cash. This is boot received 24,000. All right. So what are the tax implications? So again, because it is a case of multiple assets transfer, we will look at each transfer individually and determine the amount of gain or loss to be recognized on assets individually. We will determine the amount of gain or loss recognized. And for this, we have to allocate the amount of boot received. Boot allocated. So boot received is $24,000, and this will be allocated among three assets, 1, 2, and 3, in the ratio of their fair market value. Ratio is 1, ratio 8, ratio 7. This is the ratio of fair market values. So you divide this $24,000 in this ratio, and this comes to $1,500 for asset 1, $12,000 for asset 2, $10,500 for asset 3. In total, it is $24,000. Great. What is gain or loss recognized? In case of asset 1, loss is realized, so no gain or loss is recognized. In case of asset 2, you recognize a lower of gain realized or boot received. So it is lower of $70,000 or $12,000. It is $12,000. In case of asset 3, loss is realized, so no gain or loss is recognized. So total gain recognized by A is $12,000. What is basis of property to X company? Again, you start with the adjusted basis. It is $50,000 plus 0. That is $50,000. In case of asset 2, it is $10,000 plus $12,000. That is gain recognized. It comes to $22,000. And in case of asset 3, it is $90,000 plus 0. Again, it is $90,000. And the total comes to $162,000. What is basis of stock to A? What is basis of stock to A? You start with adjusted basis. Plus gain recognized. $12,000 minus boot received by A, that is $24,000. $138,000. Any questions? All right. Now, this generally would end your question. This generally would end your question. But in this question, in this example, if we see that the basis of property to X company is $162,000. This is $162,000. What is the fair market value of the properties? Of all the three assets, fair market value of all the three assets is $160,000. This basis of property to X company is more than the fair market value of the property transferred in total. We are not looking at the individual values, individual basis. No, we are looking at the consolidated now. We are talking about loss duplication rules. Now, this basis of property to X should not be more than the fair market value. This should not be more than the fair market value. This is what loss duplication is. In this case, there is a loss duplication of $2,000. Now, what generally is done in such a case? All right, let's see. There are two properties that have built-in losses. These two properties have built-in losses, P1 and P3. These have built-in losses. So these assets had built-in losses. Asset 1 had a built-in loss of $40,000. Asset 3 had a built-in loss of $20,000. These are loss duplication properties. What are loss duplication properties in this case? Property 1 and property 3. Let me write this. All right. Now the problem is that there's a loss duplication of $2,000 and the fair market value, the consolidated fair market value of three assets is less than the basis of property to X. Basis of property to X is $162,000 in total, but the fair market value is $160,000 in total. It is more than the fair market value by $2,000. We have to reduce the basis of property to $160,000. So let's reduce the basis of property to $160,000. So we will reduce $2,000 from the basis of property, but from which asset? From those assets that had built-in losses. So asset 1, asset 3 had built-in losses. We will deduct $2,000 from these two assets in the ratio of their built-in losses. What is the ratio of their built-in losses? 40,000 ratio 20,000 or 2:1? All right. How we do it? Let's see. So here we have two options. I'm talking about option 1 now, and this is a general rule, but there's an exception to this. What is this? So we will reduce the basis of property. We have calculated these bases of property. We will deduct 2,000 from property 1, property 3, because these have built-in losses in the ratio of their built-in losses, that is 2:1. Any questions? And basis of stock to A remains the same. That is, we have calculated this figure. Any questions? So this is what is generally done in order to bring the tax basis equal to fair market value. So you deduct $2,000 in this case, that is the loss duplication. So you deduct $2,000 from the tax basis of those assets that had built-in losses. So in this case, property 1 and property 3 had built-in losses, and you deduct this $2,000 from these assets, from the tax basis of these assets, in the ratio of their built-in losses. What is the ratio of their built-in losses? $40,000 ratio $20,000, that is 2:1. Any questions? Now there is another option. What is that? And when that can be followed? There is another option, and under this option, what you do? You don't reduce the tax basis of assets with built-in losses, but reduce the basis of stock. But reduce the basis of stock. The stock's fair market value. This fair market value after the transfer. And this option 2 is applied if both transferor and transferee agree to this. So if both transfer and transferee agree, that is in this case, both A and X company agree, then don't reduce the tax basis of assets. Don't reduce the tax basis of assets that have built-in losses, but reduce the basis of stock and bring the basis of stock equal to its fair market value. So under option 2, basis of property to X company does not change. But basis of stock to A is reduced. So we had calculated the basis of stock to A was, we calculated this figure as $138,000. From this, we will reduce $2,000. We get to a figure of $136,000. This is equal to its fair market value. This is the fair market value of the stock. And this is the basis of stock to A. So again, you have two options. In case of loss duplication transaction, you have two options. But option 2 can only be followed if both transferor and transferee, A and X company, both agree to this. Otherwise, option 1 is followed. And under option 1, you deduct loss duplication from the tax basis of those assets that earlier had built-in losses, and you deduct this loss in the ratio of built-in losses. Basis of stock to transfer does not change in option 1. So in section 351 transaction, you know that you do not recognize any gain or loss. But if boot is received, you recognize gain only to the extent of boot received. In case of multiple assets transfer, amount of gain to be recognized is determined individually for all the assets transferred. You consider multiple assets transfer as if there are multiple transfers. The basis of property should not be more than the fair market value of the assets transferred. In case the basis of property is more than the fair market value of the assets transferred, then it is a loss duplication transaction and you have to apply loss duplication rules. All right. So we have discussed the contribution of property. We have discussed the tax implication of property contributed by an individual to a corporation, and also what are the tax implication when boot is received by a shareholder. We haven't discussed so far what are the tax implication when liability is assumed by a corporation. There are detailed rules regarding assumption of liabilities by corporation. So shareholder liabilities are assumed by corporation. There are rules. We will discuss that in next session. That what are the tax implication for shareholder and corporation when shareholder liabilities are assumed in a section 351 transaction. Any questions? Great. We'll connect next Sunday and discuss more on section 351 and other transfers. So have a great day. Have a great week. Goodbye.